Okay, dear students, Assalamu alaikum. Let's start the first live revision class for the session March 2025 FR. Before we start the first class, can you quickly tell me how many lectures you people have seen? So that we can just start. What is the status? How many lectures you people have seen? Please quickly respond. You have to just write in the chat box. Just write in the chat box. Okay, that's great. What about other students? Waiting, please can you quickly reply how many lectures you have seen? So please try to, okay, I think this better speed, but again, try to speed up also, okay? Because as soon as you people can complete the lectures, the benefit is you will have more time for the revision. Let's start. We are starting our live revision classes from IAS 33. EPS, earning per share. Let's start from a formula. Profit after tax minus preference dividend minus non-controlling interest. The issue of NCI only comes when we are calculating EPS for the group. Otherwise, there will be no NCI in the formula. Divided by weighted average ordinary shares. Weighted average ordinary shares. Now let me repeat. Non-controlling interest issue only arises when we are calculating EPS for the group. Only then NCI comes, otherwise there will be no NCI. Now let's discuss preference dividend. Preference dividend is only available to the preference shareholders. When we say preference shares, there are two types of preference shares. We have redeemable preference shares, and we also have irredeemable preference shares. Irredeemable preference shares. Now listen, redeemable preference shares, they are actually your loan. They are liability. If I put a technical name, redeemable preference shares, they are financial liabilities. So redeemable preference share, they're financial liability. Now listen carefully. On loan, on financial liability, we pay interest. We do not pay dividend. Actually, dividend is only paid to the equity holders. So it means that redeemable preference shares, they are just loan, financial liability. It means on redeemable preference shares, we pay interest. We do not pay dividend. It means that the preference dividend which we are deducting while calculating EPS, this preference dividend has nothing to do with redeemable preference shares because they are liability, they are loan. On loan we pay interest, and interest is already deducted far more before calculating PAT. Now, irredeemable preference shares, they are basically equity, and dividend is paid to the equity holder. Now, irredeemable preference shares, there are two types of irredeemable preference shares. Cumulative, non-cumulative. Simple concept. Cumulative means unpaid period is countable. For example, let's say you have bought irredeemable cumulative preference shares of XYZ company in 2024, and let's assume in 2024 they have not paid the dividend. Now in 2025, they have decided to pay the dividend, and let's say they are paying the dividend in 2025. Then this organization will pay you the dividend of 24 as well as 25, because you have cumulative irredeemable preference shares. So cumulative means unpaid period is countable. When we say non-cumulative, it means unpaid period is not countable. Unpaid period is not countable. So in case of non-cumulative, if organization is going to pay the dividend, so they will be paying the dividend only for the 1 year. Another important concept. Now listen carefully, please. In case of irredeemable cumulative preference shares, either organization has declared the dividend or not. While calculating EPS, you have to calculate the preference dividend, and you need to deduct that preference dividend while calculating EPS. So repeat, in case of cumulative irredeemable preference shares, irrespective either company has declared the dividend or not, we have to deduct preference dividend while calculating EPS. In case of non-cumulative preference shares, if organization declares the dividend, only then we will deduct the dividend for the preference shareholders, otherwise we will not, in case of non-cumulative. Another point, in exam, if only preference shares is written, nothing else, we always assume given preference shares are irredeemable, and second, we also assume they are cumulative. So in exam, if preference shares are, it questions says preference shares, nothing is mentioned, then you have to assume irredeemable plus you have to assume cumulative. Now, let's talk about weighted average ordinary shares through a small example. Let's say we have ABC company, 1124. Ordinary share capital is 50,000. Par value is $0.5. Second transaction, March 24, issued 1,50,000 shares. Third transaction, issued 50,000 shares in September. Very important point, nothing is mentioned. It is always assumed end of the month. Let's say the year end is December 24. Profit after tax is 500,000. Requirement is calculate basic EPS. We are just required to calculate basic EPS. Okay. Now come here. Ordinary share capital. Whenever we have been given ordinary share capital, so ordinary share capital divided by par value will give us issued shares. So if examiner gives you ordinary share capital, so how will you calculate issued shares? Simply take share capital divided by par value. So this will give you 100,000. So simply ordinary share capital divided by par value gives us issued shares. Now, how do we calculate weighted average shares? Date, simply shares, time factor. There's one more column, that is adjustment factor. We'll see that. And the last one is weighted average. One 24. Issued shares we have calculated 1 lakh. So simply ordinary share capital divided by par value. Ordinary share capital divided by par value gives us issued shares. After 1st January 24, March 24, organization has issued 1 lakh 50,000 more shares. 31st March 24, issued shares 1 lakh 50. Okay, now we can say that on 31st March 24, total number of shares, they are now 2 lakh 50,000. Because before 31st March 24, company had only 1 lakh shares. Then on 31st March 24, they have issued further 1 lakh 50. So the total number of shares on 31st March 24, they are 2 lakh 50,000. Now, time factor is very important. Please look at this. From 1st January till March, there's a gap of 3 months. So the time factor is 3 upon 12. Repeat. From 1st January 24 till March 24, there's a gap of 3 months. It means first 3 months, this organization was having only 100,000 shares. That is why 3 by 12. Now, after March 24, they have issued 50,000 shares in September. Nothing is mentioned. It is always end of the month. 30th September 24, issued shares. How many shares they have issued in September? 50,000. Before 50, they already had 2 lakh 50. So total number of shares are 3 lakh. After September 24, no more issued shares. It means that from 30th September 24 till December 24, in the last 3 months, this organization is having 3 lakh shares. Okay, now from March 24 till 30th September 24, there's a gap of 6 months. It means 6 months the company was having 2 lakh 50,000 shares. How did I get the time factor 6? From 31st March 24 till 30th September 24, there's a gap of 6 months. So we can say that 6 months organization was having 2 lakh 50,000 shares. Then in the last 3 months, the company is having 3 lakh shares. Now, there's no adjustment factor in this question. When it comes, we'll see how it works. So 1 lakh multiplied by 3 upon 12, I'm getting 25,000. Obviously, 2 lakh 50,000 multiplied by 6 upon 12 means half of that I'll get 1 lakh 25,000. 3 lakh 3 upon 12, I'm getting 75,000. The total of the last column will give you weighted average ordinary shares. So simply 25 plus 125 plus 75,000. I'm getting 2 lakh 25,000. Basic EPS. Profit after tax, they have given us 5 lakh. No preference dividend information. So 500,000 divided by 2 lakh 25. 5 lakh divided by 2 lakh 25. I'm getting 2.222. Okay, now when the issue of adjustment factor comes, number one, in case of bonus issue, whenever organization makes bonus issue, you have to calculate bonus fraction. How do we calculate bonus fraction? That is very important. Please watch it carefully. Bonus fraction is equal to shares after bonus. Shares after bonus divided by shares before bonus. Obviously, before bonus, you will have less shares. After bonus, you will have more shares. Mathematically, the bonus fraction must be greater than 1. Repeat, how do we calculate bonus fraction? It's very simple. Shares after bonus divided by shares before bonus. Obviously, shares after bonus, they will be more than shares before bonus. And mathematically, the answer of bonus fraction must be greater than 1. Now, let's put few figures. Bonus issue. Assuming company says the bonus issue is 1:4, the interpretation is 1 bonus against existing 4 shares. 1:4 means 1 bonus against existing 4 shares. It means that the BF bonus fraction is going to be, before bonus there are 4 shares, but after bonus they will become 5. Because against each 4 shares there will be 1 bonus. So obviously shares after bonus they will be 5, before bonus they are 4. And obviously mathematically the answer is greater than 1. If I divide 5 divided by 4, I'm getting 1.25. Now listen carefully. This bonus fraction is multiplied by with all the shares they are in the question and they are before the bonus. Repeat. This bonus fraction, another name is adjustment factor, is applicable on all those shares they are before the bonus. For example, ABC company, 1124, ordinary share capital is 1 lakh. Let's say the par value is $0.5. 30th June 24, issued 50,000 shares. Bonus issue 1:5 in September. Profit after tax is 4 lakh. Year end is December 24. Required basic EPS. Obviously, first of all, we have to calculate weighted average shares. Without weighted average shares, we won't be able to do anything. Ordinary share capital is 1 lakh. Par value is 0.5. It means that 100,000 divided by par value. So issued shares are 200,000. Issued shares are 200,000. Okay, now. Date, shares, time factor, adjustment factor, weighted average. 1124 issued shares. We have 2 lakh. After that, organization has made 50,000 shares issued. On 30th June, Issued shares 50,000. It means we can say that on 30th June 24, total number of shares are 2,50,000. From 1st January 24 till 30th June 24, there's a gap of 6 months. It means first 6 months organization was having 2 lakh shares. Now, bonus issue in September. Please watch it carefully. Whenever date is not mentioned, it is always end of the month. 1:5. What will be the bonus fraction? Another name is adjustment factor. 1:5 means organization is issuing 1 share against 5. So it means after bonus, the shares will become 6. Before bonus, they are 5. And mathematically, the answer is obviously more than 1. That's 1.2. Great. So your adjustment factor is 1.2. Now come here. 30th September 24. Bonus issue. Before bonus, total number of shares are 2,50,000. And company has issued 1 bonus against 5 shares. So how many bonus shares they have issued? 50,000. After bonus, total number of shares they will become 3 lakh. And after bonus, there's no other issued shares. So it means from 30th September till December 24. Last 3 months, organization was having 3 lakh shares. Now listen carefully. Bonus fraction is only applicable on those shares they are before the bonus. Okay, now. From 30th June 24 till 30th September 24, there's a gap of 3 months. So 3 by 12. And last, it is also 3 by 12. Now let me repeat. Bonus fraction adjustment factor is only applicable on all those shares they are before the bonus. Obviously, 2 lakh shares they are before the bonus, so the bonus fraction 1.2. Even 2,50,000 shares they are before the bonus, so 1.2. 3 lakh shares they are after bonus. That is a bonus fraction will not disturb 3 lakh. Why bonus fraction is not disturbing 3 lakh? Because 3 lakh is after bonus. And the concept is bonus fraction is applicable, adjustment factor is applicable only on those shares they are before the bonus. So now let me use the calculator. 200,000 6 by 12 obviously give us 1 lakh. Then into 1.2, 1,20,000. You need to multiply them. Now multiply here. 2,50,000, 3 upon 12 into 1.2. Students, I'm getting 75,000 here. And 3 lakh, 3 by 12, 75. So now another thing is 6 plus 3, 9 plus 3, 12. So obviously your accounting period is 12 months and we have done the working for 12 months. So 1,20,000 plus 75 plus 75. I'm getting 2,70,000. Very easily we can calculate basic EPS. Profit after tax is 4 lakh. Divided by 270. 400,000 divided by 2,70,000. Students, I'm getting 1.48. That's good enough. Otherwise, with a rounding of 1.5. 1.148148. So otherwise 1.48 is good enough. That is your basic EPS. So let me repeat. Bonus fraction adjustment factor is applicable on all those shares they are before the bonus. Now, examiner is having actually two options to give you the information of the bonus. One is examiner gives you the bonus information in the ratio, like we have discussed 1:4, 1:5. Another possibility is examiner might give you the bonus in terms of percentage. For example, examiner says the bonus issue is 20%. Okay. If bonus issue is 20%, then bonus fraction is simply 1.2. If examiner says bonus issue is 30%, then your bonus fraction is 1.3. Basically, this 1.3 is what this 1.3 does. 30% means your total number of shares, they will become 130%. 30% bonus means total number of shares, they will become 130%. Obviously, if there's any number, you multiply that number with 1.3, so it will become 130%. So let me repeat, examiner obviously can give us the bonus information in the form of ratio, and the second is percentage. If bonus issue is 20%, then bonus fraction adjustment factor is 1.2. If bonus issue is 30%, then bonus fraction is 1.3. Now, another concept, right issue. Right issue is only available to the existing shareholders. Right issue is only available to the existing shareholders, number one. Number two, a right issue is issued at a lower price than the market because organization wants to give incentive to the existing shareholders. Repeat, right issue is given to the existing shareholders. It is not free of cost. Shareholder will have to bear the cost. But in right issue, there is an incentive. The incentive is organization will issue the right shares at a lower price as compared to the market. Okay. Now listen carefully. Whenever organization makes right issue, then according to the perception anticipation of the stock exchange assumes that, or you can say that this is the perception of the stock exchange, that everybody will be selling their right shares. Why would they will be selling the right shares? Because in order to get the benefit, because right issue will be issued at a lower price as compared to the market value. Now listen carefully. So according to the anticipation perception of the stocks, everybody will selling the right shares, their right shares. So the selling pressure will increase. If the selling pressure increases, if everyone starts selling the shares in XYZ company, selling pressure increases. Due to increase in the selling pressure, your current share price will drop, will reduce. So due to right issue, share price will always reduce. Okay, this is number one concept. And the share price which is after right issue, there's a technical name. The technical name is TERP. That is theoretical X right price. Interpretation, share price after the right issue. As I mentioned right now, the share price after the right issue will be lower than the share price before the right issue. Another point is, in right issue, there is an adjustment factor, or you can say that in right issue, the bonus element is built in. So we have to calculate that as well. How do we calculate adjustment factor in case of right issue? Adjustment factor, that is, we'll take share price before right, share price before right, divide by theoretical X right price, and mathematically the answer must be greater than 1. Because share price before right will be more than theoretical X right price. Theoretical X right price means share price after the right issue. And the share price after the right issue will always be less, will be lower than the share price before right. Now, after calculating adjustment factor, this adjustment factor is applicable on all those shares they are in the question before the right. This adjustment factor is applicable on all those shares they are there in the question before right. Now, Another important concept, please listen, then we'll see how to calculate theoretical ex-right price. If now listen carefully, please. If examiner gives you the two dates, let's say examiner gives you the announcement date of the right issue and examiner gives you the entitlement date as well. For example, examiner says announcement organization has made the announcement of the bonus on 30th June 24, but entitlement date is 31st July 24. So now listen carefully. Whenever two dates are given in the question, whenever two dates are given, one is announcement date, another is entitlement date. We will always work according to the entitlement date, not according to the announcement date. And obviously, nothing is mentioned, then we always assume announcement and entitlement date they are same. But whenever categorically examiner gives you the information of announcement date and entitlement date, then entire calculation will be performed according to the entitlement date. Okay. How do we calculate adjustment factor in case of right issue? For example, let's say there's a right issue. 1:2. Share price before right. Let's say the share price before right is $20. The right issue price is $16. So right issue will always be issued at a lower price as compared to the market so that we can give incentive to our existing shareholders. Let's say the requirement is very simple. Calculate theoretical X right price and calculate adjustment factor. The ratio of the right issue is 1:2. So how do theoretical X right price means share price after the right issue. So how do we calculate TERP? Shares, values and total value. Right issue ratio is 1:2. So one right against two existing shares. One right against two existing shares. Share price before right is 20 and the right price is 16. So 40. So it becomes 56. Simply multiply them. So we can say that three shares they are having total value of 56. If three shares they are having total value of 56, I can easily calculate the share price of value per share. Okay, great. 18.67. So 56 divided by 3. 18.67. Adjustment factor we can easily calculate 20 upon 18.67. Or you can work by using 20 upon 18.767 or otherwise you can just divide this. Students, I'm getting 1.07123. Or you can make it 2.4, no issue at all. This adjustment factor is applicable on all those shares they are in the question before the right. Okay. And let me repeat, whenever two dates are given, one is announcement date, another is entitlement date, then we always work according to the entitlement date. Now, come here. Let's say we have issued shares 10 million. Issued shares 5 million. 30th April 24. Right issue. Assuming 1:2 in September. Right issue price $20, comma. Share price before right. Share price Share price before right is 25. Year end is December 24. PAT is 6,50,000. Required basic EPS. Let's calculate. Date, shares, time factor, adjustment factor, and weighted average. Now, let us perform one working of right issue. Shares, values, and total value. 2 1. Share price before right is 25 and the right price is 20. Just multiply them 50, 20. We can say that 3 shares are having total value 70. So I can easily calculate value of 1 share, TRP. 70 upon 3. I'm getting 23.33. Adjustment factor 25 upon 23.33. You can take this as it is, no issue at all. Now come here. 1124 issued shares, there are 10 million. Then 30th April, how many shares they are issuing on 30th April? 5 million. So it means on 30th April, total number of shares will become 15 million. From 1st January 24 till 30th April 24, the time period is 4 months. After 30th April, company has made right issue in September, and we know that nothing is mentioned. Whenever nothing is mentioned, it is always end of the month. So 30th September 24, issued shares. So 30th September, they have made a right issue. Right issue. Now listen. 15 1 upon 2. So the right issue is 7.5. Before right, the total number of shares are 15 million and the right issue is 1:2. It means number of rights, they are 7.5 million. Total number of shares after right, they will become 22.5 million. So from 30th September 24 till December 24. Last 3 months, the total number of shares are 22.5 million. Okay. Now let's go for the time factor. From 30th April till 30th September, the time period is 5 months. So 15 million into 5 months 12. And here we have 3 by 12. Now another point. Adjustment factor is only applicable on those shares they are before right issue. Adjustment factor is only applicable on those shares they are before right. So adjustment factor, you can write 25 upon 23.33. Obviously 10 million shares they are before right. Even the 15 million shares they are before right. But we cannot use this adjustment factor on 22.5 million because 22.5 million shares, they are after right. Adjustment factor is only applicable on those shares they are before right issue. So let us use the calculator. 10 multiplied by 4, then divided by 12, multiplied by 25, divided by 23.33. Students, I'm getting 3.57 with a little bit rounding of 2 million. Please check. 10 multiplied by 4 divided by 12, then 25 divided by 23.33. Yes, everyone is getting the same result. Next, 15 multiplied by 5 upon 12. 6.25, then multiply by 25 divided by 23.33. Students, I'm getting 6.697. So 15 multiplied by 5 upon 12, then 25 upon 23.33. The last one, 22.5 multiplied by 3 upon 12. 5.625. Now let's add all of them. 6.697. Student, I'm getting 15.894 million. Let's recalculate. Just check. 3.572 plus 6.697 plus 5.625. So 15.894. Now we very easily we can calculate basic EPS. Profit after tax is 6,50,000. So let's convert this 6,50,000 into 0.65 million. Because shares are in million, so 6,50,000 means 0.65 million. 15.894. So let's see. 0.65 divided by 15.894. Students, I'm getting, please check, 0.04089. Yes or no? 0.65 divided by 15.894. Okay. Now, student, please listen carefully. I'm just writing a small data. I want everyone to attempt this. ABC company incorporated 1124 issued shares. That will be your little homework, you can say. Issued shares 10 million. March 24. Issued shares 25 million. June 24. Year end is December 24. And simply you need to calculate weighted average. Now listen carefully. Number one, it is just the first live revision class. That is why I don't want to take this class very long. Second, obviously from the next class, we will be doing the revision, plus we'll be doing the kit questions as well, obviously from the past papers. Third, only for the coming week, there will be no live revision class. Why? There's a reason. The reason is because I've kept the meetup at Malaysia. So I'll be traveling to Malaysia for ACCA meetup with my students. So inshallah, after that, just 1 week, there will be no live revision class. But after that, inshallah, there will be classes. Thank you, students. So these were the few announcements. So see you all, inshallah. And plus, please try to do this little homework. But don't worry at all. In the next live revision class, inshallah, we'll start from this question. Yes, I'll be doing in Karachi as well. Don't worry at all. Don't worry at all. Because so far we have done meetup at 3 places. We started from Riyadh, number one. Second was Islamabad. In Islamabad, it was really awesome. And now the third one is in Malaysia, KL, inshallah. And then obviously we'll be doing in Karachi as well. So, students, thank you very much. Thanks a lot. Yeah, the timings, everything will be little bit. Obviously, it will from next class onwards, the timing will be earlier than this. Don't worry at all. Far more earlier than this. Don't worry. Okay, students. Thank you.